Hey there, hope you're doing well today. Gonna go over some business math stuff that will hopefully help you make some money and not lose some money. All right, this is probably the last talk here on investment, unless I think of something else great to talk to you guys about. But we'll keep the investment game open here until the end of the year. That way, you guys can see if you guys end up beating me or if who ends up in first place. We'll see. But um, currently, I am in last place, as you guys can see, because I took on the most risk early on in the game and I really loaded up on stocks at a very poor time. And then the market tanked here. So I'm down $14,000 in simulated money. Um, but you can see Netflix is actually doing quite well. So if you loaded up on Netflix, you would be up a lot of money there. But American Express, big downer. Goldman Sachs, also bad. Um, Even Tesla, okay, they've been doing really good lately, but they're still negative since when I bought them. Okay, so all these companies are in the red. Microsoft is like the closest to not being in the red right now. Okay, and so overall, Kuster is still in the lead, and Vinny, you're still one ahead of me, and I don't think any of the positions changed. But the market is maybe making a comeback here, so we will keep this open and we'll see. Um, it might be a good time to buy right now before it decides to go up another 10%. Of course, it could always fall another 15, 20%. Who knows? Um, so my buying power right now, this $41,000, I just liquidated it and bought a whole bunch of something. Okay, something that I think is rather cheap and will make a quick comeback to hopefully catch you guys in the end. But we will see here. All right. Um, all right, let's talk about this worksheet here where you guys had some good answers, some not so good answers. If you missed a whole bunch, well, sorry, I'm going to deduct points because you didn't read close enough. Okay. So look at this first one. Okay, so you had a word bank, so it had to be one of these eight here. Um, Something that reduces risk, combining stocks, bonds, real estate. Okay, like real estate is normally not in, that's kind of a extra, not so main class of investment, but that could be a sizable portion of someone's portfolio too. Um, okay, having a variety, okay, and a portfolio of stocks, diversification means reducing the risk of individual stock by holding many companies. Okay, mutual funds offer one way to diversify. So, guess what word it is? It is diversification. Okay, so number one was diversification. Don't put all your eggs in one basket, spread it out. Okay, we're not talking about the percentage split down. That's coming up here. All right. Um, okay. For number two, blank means investing in different broad categories or classes. Okay. These are like large categories. Three major classes: stocks, bonds, and cash. All right. When you're deciding what percentage, okay, so here we're talking about percentage. If you read this next bullet, um, it tells you the answer. Ooh, did you read that? I hope so. Okay. According to some financial advisors, asset allocation can account for 90% of your returns in performance. Okay. And one of the big factors, of course, is your risk factor and your risk tolerance, and your age. Okay. How close you are to needing the money as well. Okay, investment time horizon. All right, let's go on to the third one. Now, this one's a little bit newer. Um, Investment values tend to rise and fall, so the asset classes do not remain the same. So you got to review your investments, okay? So you want to review your investments to come back to your asset allocation. So it's becoming uneven. Okay, so the idea of something becoming uneven and you're putting it back to how it was, this is what we call rebalancing. Okay, rebalancing your portfolio. All right, let me not write with this pen anymore because that's just way too difficult. All right, but anyhow, rebalancing your portfolio is making it so it goes back to the asset allocation that you want. Okay, so like let me give you an example here. Say if you have $10,000 to invest, okay, and you invested it, and let's for simplicity say that you want to be 50% stocks and 50% bonds. Okay, now I would recommend you thinking about this if you're maybe like age 50, okay? Maybe, yeah, maybe even if you're age 60, that would be a good asset allocation. It's too conservative for somebody young, okay? But that's my investment advice, but I think anybody that has knowledge of financial investments would tell you the same thing. All right. But anyhow, so if that is your asset allocation and then the market, like it has been, plummets. So stocks fall, 40%. Okay. So if stocks fall 40%, okay, your money, which if it was 50% stocks originally, that would have been $5,000, and 50% bonds, that would have been $5,000. Okay, but then, stocks fall 40%. Okay, so that $5,000 would turn into, so now your stock part of your portfolio is down to, or now, if it falls 40%, it would lose $2,000. So it's now $3,000. And bonds, well, a lot of times bonds actually might gain a little bit during this time. So your bond part is now $5,500. And so what that means is your asset allocation is no longer 50-50. It's now out of whack here. Okay, so let's pull up El Calculadora and figure out what percentage stock you have now. So you got $3,000 in stock, okay, divided by 8,500 total, okay? So you are now looking at about a 35% stock allocation, okay? And you have 65% in bonds. So when the market recovers, you're going to get a lot less money back because, well, guess what? Your stock allocation is a lot less than you originally intended. So when there is a big drastic decline in the market, like there was, you have to rebalance your portfolio to get back to your intended target goals, okay, so that it can rebound. And actually maybe even exceed and shoot over what you had originally, okay? So you don't want to, deviate from your target stock allocation by around, they recommend you rebalance annually just in case it drifts like 5%, okay? But if there's a drastic decline, you might need to rebalance sooner, okay? So basically when you rebalance, you take some of the bond money and you move it back over to stock, okay, till it gets back to 50-50 here. All right, so hopefully that makes a little bit of sense for you. All right, so the final one here, this is the idea of you cannot time the market, okay? So you basically have a set amount of money that you invest on a regular basis over a long period of time, okay? And so since you are kind of investing it on a regular basis and you're buying some when it's up, buying some when it's down, there's the key word, okay? This is what you call by dollar cost averaging. Let's see what word that's the word they use, dollar cost averaging. Okay, so dollar cost averaging makes it so you never buy when it's the most expensive, but you actually never buy when it's cheapest either, because no one could actually predict when it's going to be the cheapest. So instead, you consistently buy shares at different time periods. Like, so for instance, you know, um, Amazon, okay? Amazon is sitting at roughly $2,000 a share, okay? What it was now. But before the market fell, it was sitting maybe at $2,100 a share, okay? Um, Actually, Amazon held up pretty good because of everybody's buying stuff from Amazon, but it did go down originally a little bit. So the idea is you'd buy shares at 2,100, buy shares at 2,000. Maybe you would buy it at its cheapest point at 1,900. Okay. But because you are buying, like say we bought, maybe you bought before it crashed at February, you bought at 2,100. In March, you bought at 2,000, and then at the beginning of April, you bought at 1,900. Okay, and then the average price you would have paid is 2,000, which is in the middle, and so that's nice. Okay, you don't buy at the highest, you don't buy at the lowest, so it takes the risk out of investing somewhat. All right, so hopefully that kind of makes sense there. That you want to buy at regular basis on a regular basis so you don't get caught buying too high or too low. All right, so let me just recap like in a quick summary of the main points that I want you to get from all of these lessons here, okay? So just what I just said a second ago, you cannot time the market, okay? And since you can't time the market, really the sooner you invest, the better. Because if you remember the rule of 72, okay, the more times your money the more time that you have your money invested, the more times it will double. Okay, you take 72 divided by the average percentage that you will get for whatever asset allocation you would have. Okay, you do dollar cost averaging because that avoids timing the market. Okay, number two, your asset allocation is one of the most important decisions when you are determining how you will invest. That affects 90% of your returns. Okay, and you want to be more in stocks because stocks greatly outperform bonds. And stocks actually outperform all other investments. I don't care if you love gold. Gold is cyclical. It's going to go up, it's going to go down based on demand, based on inflation. Okay. And some people are thinking, oh, gold's going to the roof. All right, well, it might go up for a year or two here when inflation hits, but it's gonna just cycle back down and kind of level off. Stocks are consistent. The stocks make money, okay, because you're investing in companies that make profit, and so the best way to invest is being largely in stocks. Okay, number three. As you get older, adding government bonds reduces risk. So as you approach retirement, you want to mitigate risk, and so you want to shift some of your percentage to bonds. And then there is the rule of 110 or 120, which is, take your age. 110 minus your age is what percentage stocks you should be. Okay, so that's equal to what percentage stock funds. Okay, I'm not going to say stocks. Because you don't want to be in just stocks. 110 minus your age is equal to stock funds. I said I was going to use this pencil, and now I'm still using it. All right. Number four, be skeptical of active mutual funds because fees may eat up returns. Consider passive index funds instead. Yeah, so, Dave Ramsey loves active mutual funds, but, you can basically eat up about 2%. Okay, to anywhere from like 2% to 5% if you're getting active mutual funds in fees. And that means you have to gain 2 to 5% more from those mutual funds before you get back what you started with. And so I don't, unless you know a really good fund or unless that's what your work does, then I would seriously be skeptical of that. And number five, diversification is key. Buy funds, not individual stocks, because you don't want to put all your eggs in one basket. You want to buy mutual funds or ETFs, which are cheaper mutual funds. All right, that's it, guys. Have a great day. Take care now. Bye bye.